Good morning on September 27, 2023. Good morning, Stuart.
Good morning.
This is our weekly investor webinar. We're talking about lithium today and about BrainChip. There's a lot happening with the Core Lithium, and there's a lot happening with BrainChip. So a lot to talk about. So, Stuart, let's just jump straight in with Core Lithium.
So, Core Lithium is a bit of religion amongst certain stocks, amongst certain investors, I should say. There are people who bought this stock at about 20 cents a share, and they made out quite well. The stock raced well above $1 as it was bringing the Finniss lithium mine in the Northern Territory into production. The stock's now reversed course. Go back for a second, Mark. The stock's now reversed course, and we're hearing a lot of chatter about people worried about Core Lithium. So let's talk about what the stock, what's to like and what's not to like. All right, who's Core Lithium? Up close to Darwin, there's a large block of ground that's very prospective for hard rock lithium. And over a period of about 5 years, Core Lithium was able to discover and then develop a new lithium mine called Finniss. They shipped the first spodumene concentrate from that mine in April of this year. And about 9 months before that, they changed CEOs. So put in charge Gareth Manderson, formerly of Rio, who knows how to run mines, as the new CEO. Stocks had a bad 2023, and they've compounded things by just announcing a $100 million placement at 40 cents a share. And we'll look at the chart in a moment. The chart is actually absolutely terrible. As you can see there, it's almost a perfect reverse U. There's that 20 cents a share level over there in about middle of 2021. In fact, it base built there for quite a while before it shot off into the stratosphere in 2022. Now it's almost reversed all that ground. So it's interesting to me from that perspective because at some stage, everyone is going to start hating Core Lithium, which could make it an outstanding buy.
It looks like that has happened already, Stuart. Everyone seems to hate it.
Well, as in there's hatred and then there's murderous hatred. I think we've got to the hatred point. We're about to get to the murderous hatred shortly, to the point where if you bring up Core Lithium in polite company, they might throw you out of the barbecue.
Right. I know you're going to this in the next slides, but what always surprises me with these sorts of movements in share prices is if you look at where the company was, say, 2 years ago, we're back at that same share price level, right? The company should be, realistically, a lot further ahead in its journey. Right. And also with the cap raise right now, it should be in a better position than it was. So it's always amazing to see how Mr. Market at some point just dislikes companies just because because of the sentiment, or it just dislikes markets. Right.
So we'll look at what Mr. Market's got right and what's not right at the moment. But Mark, what would be your conclusion without knowing anything? Go back to that chart. Tell me what you would think without me telling you anything.
Well, look, I know there was some issues a little while ago with Core Lithium, and we actually wrote about Core Lithium on the Stocks Down Under website around that time. When that first dip, this was early 23. You see the share price dipping to 75 cents, and then it bounced back up. Around that time, we wrote about Core Lithium, and we said, look, with stuff that's going on at the moment, don't be surprised if this stock will go a lot lower, because this sort of stuff never comes alone, right? If there's a setback, there's always more. At some stage. So in that sense, it doesn't surprise me, but going all the way back to 34 cents, given, it's true on the back of a very deeply discounted cap raise, but it's still a bit of a surprise because the company should have made some progress in the last 2 years, right?
Right. I'll quote Shakespeare at this point. When troubles come, they come not single spies, but in battalions.
Exactly. Well, that's what's happening here. And it's what happens on the stock market quite a lot, actually, when stocks get into trouble.
Right. So let's talk about where we're sitting with Core Lithium and why investors should be paying attention at the moment. Okay. So this mine just got up and running. In FY24, it'll produce about 80 or 90,000 tons of the product. This mine is exquisitely located, just 90 kilometers up the road to the port in Darwin along a sealed road. And at the other end up in China is Ganfeng and one of its competitors, Yahua, who are taking the material on offtake agreements. Meanwhile, back in the Northern Territory, this grade is high. As a rule of thumb, greater than 1% lithium is always attractive in lithium resources. And look at that reserve, 10.6 million tons of the stuff, 30 million at resource, and that's growing all the time. The operation is just one little open pit at the moment, just a starter operation. The deposit they've identified as their cornerstone, BP33, they're evaluating that at the moment. They won't come up with a final investment decision on that part of the project until early next year. So in other words, just like the carpenters sang back in the 70s, it's only just begun in terms of the potential upside you can get. And when you get a good hard rock lithium play, it can be a multi-generational asset if they play their cards right.
You know what happened to Karen Carpenter, right? So,
exactly, yeah. So you could starve before the good times start, basically. There's 500 square kilometers of exploration ground sitting around where Finniss is. And the company's actually set aside some money from its budget to go drill a heck of a lot of RC and diamond, looking for what can add to this resource. So it's big now. Well, it's medium sized now. It's going to be big if Gareth Manders and his colleagues have their way. Now, we'll talk about the raise in a second, but this company has no debt based on this mine, and it'll have over $200 million in cash. So well funded to do whatever it needs to do before investor sentiment comes back to this one. So that's what's to like about this operation right now. So what went wrong? First of all, it was a market darling. I kept on seeing chatter about Core Lithium, CXO this, rocket emoji, you know, the dumb stuff that retail investors like to talk about. That was 2021, and the peak was about November 2022. 2023, people have worried about the price of lithium. Mark, think about the discussions you and I had when we were contemplating a certain lithium play for stocks down under earlier this year. And we got it right. But in the meantime, the traded price of lithium, we'll show a chart a little later on, was going sideways. Briefly stabilized, and then lithium stocks were away. Now it's turned the other way. Important thing is this. New mines always have teething issues. You can do all your planning, but until you're actually digging the stuff out of the ground and processing it through the plant, you haven't done all your learning. So, and that's not just true of new mines; it's true of new factories. There's a famous book from the 1950s I encourage investors to read all the time. Common Stocks and Uncommon Profits is the title of the book, and the key theme there is always wait for the teething issues to show up, because all the chickens will flee the stock. And at the point where the last of the teething issues are out of the way, you suddenly get a bargain basement opportunity for a new factory or a new mine.
Was that book written with resources stocks in mind, Stuart?
It wasn't, and but the same principles apply to anything that's new, basically. But I mean, the mining industry is notorious for this. The reason I'd be encouraging any young person to seek a career in mining engineering is because those skills are always going to be in demand. You want fresh minds to come in and sort out potential problems in mines that are always going to show up. Now, this company's issues are its recoveries are lower than expected, at least lower than the analysts were expecting. So the 100 million raise is to debottleneck the operation, and they're expecting lower production in FY25 before they get that done. But it was July 2023, the guidance related to this debottlenecking they needed to do that took them down. Meanwhile, the shorters got in and did their worst, and the company is now about 8.8% shorted. So the usual suspects, Pilbara Minerals, Genesis Minerals, and Flight Centre are all more heavily shorted, but this is still a pretty heavily shorted stock itself. There's the price of lithium, but not just any price. Lithium's one of those unusual commodities where you can never quite tell what the spot price is. This is the traded price as it lands in Chinese ports, as priced in renminbi. Relatively little lithium actually changes hands at this price. This is the loose material that's lying around that changes hands, allowing the Chinese traders to monkey around with the price. So as you can see, at the same time, Core Lithium was re-rating. The price of lithium, according to that measure, which is freely available, you can go look at it every day, was racing hard. Lithium's come down, bounced, and then down again. So the fruits of that is that you've got this situation where lithium has been dropping heavily as far as people can see it. Now, if you look through that, the long-term demand for lithium is such that the world just doesn't have enough of the stuff. So the immediate spot price is probably not a realistic explanation of what's going on in the real world, but it's the one that everyone looks at. So you want this particular chart to turn around before lithium is in good shape.
Right. So there's that spot, the share price there where we where is that? So when was it? May, I think. So that initial dip that you see there, that's when we picked that one particular. Well, actually, we can name the name. It's Leo Lithium. We did really well on that one, and we got out before the initial trade, the first trading halt.
Right.
But we're at the same level there. But what we've been doing is really watch that the pivot here in the price, and I think you should do it now as well. Not just for, in this case, for CXO, but for any lithium play. Although, like you said, Stuart, there's not a lot traded at this price. It's not it's one of the things that we actually, as outsiders, can actually monitor, right, in terms of pricing. So it's turned out to be a good indicator previously. So definitely watch this price development.
Right. So let me summarize where we're at. Watch this stock like a hawk. And the reason is Core Lithium is a very well-placed mine. It's rare to actually get this kind of location in a rich lithium field, a field full of granites that are rich in this sort of stuff that you would find in Core Lithium. And I've talked about the advantages this company has. But yeah, watch the price of lithium carefully. Watch for any hiccups in the quarterly numbers. Importantly, listen carefully to what other people are saying. If everyone hates the stock with a passion, like with a murderous hatred, that's when to actually start looking carefully, because it's probably reached the bottom at that point. Rule a line across the bottom there. 20 to 23 cents is probably the resistance of the support level for this stock. Breaks through, then it's anyone's guess what happens. I think the management are probably not too worried about what the current share price is. They're concerned about setting this company up for really long-term growth. I remind you, Gareth Manderson joined this company from Rio Tinto, and he was a 20-year veteran for Rio Tinto. Rio Tinto operatives don't care about the Rio Tinto price. What they care about is setting up the assets they're working on for long-term, low-cost production, and that's what Gareth's working on now. So not so good in the near term for Core Lithium shareholders. Probably good in the long term. Is the way I think about this.
You watch director buying quite closely. Have directors been buying in this stock recently?
Yeah, they've been taking their fair share of the share purchase plan related to the placement. Now, keep in mind that the stock's underwater on that one, so it's not working out so well. And that's a near term problem as well. Is the share purchase plan happen at a time when markets are not in great shape? Without knowing the details of when the window opens or closes on an opportunity like this, I'd also watch for that. When Gareth himself and some of his colleagues are prepared to put their hard-earns into this opportunity, that's probably the time.
All right, good stuff. So let's keep a close eye on that one. Another one to pay a lot of attention to, if you own it, definitely, but also if you're looking to get into it at some point, is BrainChip. That one has been falling like a rock. And the question really is, have we reached the bottom yet? Because the other day we reached 18 cents.
You might say, Mark, it's a no-brainer, right?
Well, I'm not I like the idea of a joke on this one, but I'm not sure if it's a no-brainer. Because as you flagged with the CXO, if certain support levels break, then there's more downside to it, right? So,
right.
Yeah, maybe we need some artificial intelligence to figure this one out. But a little while ago in July, we looked at the chart of BrainChip, and we concluded, you can see it on the right, that slide that we used back then. We concluded that support at around 30 cents needed to hold for BrainChip not to go down further. And of course, now we're 10 weeks later. We've seen that support around 30 cents. We've seen that break. And so we went down to 20 cents, and actually we fell through that level as well. We've seen 18 cents just on Friday and Monday, I think. So it's definitely fallen through those support levels. And by the way, Stuart, I'd say, unfortunately, is this stage where you and I still own some BrainChip shares.
Right.
And we rode part of the way down on this one, luckily not all the way from that top. After previously having been very successful with BrainChip, but that's, you see how sort of tides can turn with certain stocks. But now what is really the question for investors, either when you own it or if you look to get in, because at that support level of 20 cents, that broke. And so what's next, right? So on the right there, you see the chart. This is up till the close of yesterday. And you can clearly see that support level, the lowest horizontal line there, that is the 20 cent mark. And the low was actually 17.5 cents yesterday. And clearly visible is that the stock broke through that declining, so the trading range, broke through the bottom of that one, the trading range, and then subsequently broke through the 20 cents support level. So really, what's next for BrainChip? If you look at this chart, all the way on the left, you can see some circles there. And those were the gaps that were formed back in, when was this, 2020 and 2021, by the looks of it. Yeah, late 2020. And so these gaps start when a stock jumps from one day to the next. So it's called a gap, where the stock just jumps higher in this case, and it sort of leaves a gap. Basically, that's where the word comes from, obviously, but it leaves a gap in the chart. And historically, a lot of gaps get filled at some point down the line, right? So meaning that if you have an upward gap at some point in the future, share price will come down to basically fill that gap, the trading area, so the price levels that haven't been, that where the gap is from earlier. So what we see now is that with the decline that we've seen so far, all these gaps have now been filled, which in itself is good. But obviously, shareholders would have liked the share price to have gone higher rather than fill these gaps. And now the question is the break through 20 cent support level, is that an actual break, or is it a false move? And basically, we'll know in the next couple of days, because typically, the standard time period to verify a break is about 3 trading days. Sometimes it's a bit longer than that. So we'll find out really soon if this is a permanent break through the 20 cent level. If it's a false move, we see upside to around 20 cents, which is the lower end of that trading range. So it's circled on the right there at the top. That's around 20 cents, and 26 cents, and that would be a 30% return in the very near term. So if you're a trader with a lot of risk appetite, you can play this one, but keep in mind, have a tight stop loss, because if it goes down, and I mean if this downward break is confirmed, probably 12.5 cents is where we could be going, and that's a 34% downside, right? So there's a lot of downside. And then finally, for the fundamental investors, if you look at this one, so in a very near term, you've got 30% upside and 34% downside, depending on which scenario plays out, which means that the risk-reward ratio doesn't look favorable at all. So you need to be very careful with this one. And actually, what you want to see is a turnaround in the stock where it's actually confirmed by moving averages, but that could be a while, right? So I suspect if you're a fundamental investor, you want more solid news coming out of the company in terms of announcements, revenues, all that sort of stuff. Hopefully, at some point, moving towards profitability and cash flow break even. That is some time away, I think. So purely fundamentally, we'd say be careful with this one. Yeah, and again, depending on your risk appetite. If you're a trader, you could play this one, but keep a very tight stop loss, because you could get hurt with this one really quickly if you're not careful, because the volumes are big. I think the other day we had more than 25 million shares traded. Be careful with this one. And again, fundamentally, wait until we see that turnaround in fundamentals come through in terms of news flow. Potentially, we might do an interview with management if they fly over to Australia in November. We're not sure about that yet, but hopefully we can catch up with them then to see what's going on. In the meantime, just be really cautious. And Stuart, for you and me, the conclusion is we wrote this thing all the way down from where we got in. And
you and I are supposed to be investment professionals, Mark.
Yeah, that's true. But even professionals make mistakes, right? In fact, a lot of professionals make mistakes, and it's a good thing that the position wasn't too big, so it was sort of a punt. But luckily, we made some money on other stuff as well, right?
Right.
All right, I think that's about it. Stuart, any last words from you? I mean, not in live, but for this particular webinar.
So obviously, the market is a worrisome place at the moment. You saw iron ore drop 5% yesterday. I've been telling people, watch iron ore carefully, because if the Chinese economy is cracking up the way I fear it is, suddenly their demand for iron ore will freeze up. And I think yesterday's move possibly suggests that we're in for 2 or 3 months of really stormy weather. in the markets if what I fear in China actually happens. And iron ore is the canary in the mine on that one. So watch that one carefully.
All right, good stuff. Yeah, overnight, obviously the bond sell-off didn't help the markets either. So I suspect in the very near term will be a rocky ride for investors. So we'll wrap it up here, and we'll see you next week.
See you next week.